And we should be live. Alright guys, everybody requested this weekend I sent out a announcement, free mentorship live stream this weekend, and the options were psychology/risk, building a model, how timeframes work, which is actually, I expected this one to be the most popular because I believe that this is the most important and the reason why most people struggle with like an actual profitable model. It's because they find some system or model that actually works, but they don't incorporate timeframes in there. And then passing prop firm accounts, that one's also pretty popular. I mean, who doesn't want to know that? That's how you actually end up making money down the line. But these three are definitely the first components that you need to master before you get into actually passing those accounts. So I'm going to go ahead and share the live stream real quick. I said I'd send the link. And I'm going to go ahead and share it on Instagram as well. Okay, let's get started. So the first thing that I wanted to cover, what does a model actually consist of? So this is probably you guys right now, like all confused, scratching your forehead, because you've began studying and now that you've learned some of the concepts, you're struggling to actually like figure out exactly how they work. And that just means that you weren't actually paying attention to the right thing when you were studying. Like if you were watching ICT 2022 mentorship, which is what we tell most of the students to go watch, is because you weren't paying attention at like how he was trading, but rather with what he was trading. You were looking at the fair value gaps, order blocks, liquidity, and you missed the fact that he was trading them all together, right? So what does a model actually consist of? So the first thing, the most important thing is like time, right? Inside of a session and a specific time inside of that session, which is known as a kill zone. Day of week. So you obviously don't want to be trading on a Monday with no news or Tuesday with no news. You want to find a high probability day. That comes down to this last one right here. Like even though you might be trading in a specific day of the week for your model, it might not be a high probability day. The next thing that you need to consider is time frames. As I mentioned, I did want a lot of people to like choose that option because it's one of the most important things. People always ask what's the best time frame? And the answer to that question is that there is no singular best time frame. It's about how you use the timeframes together and the specific like scenario of how the timeframes like combine. They are all supposed to align perfectly for you to have a solid setup. And next is confluences. So you've probably learned sessions and kill zones, weekly profiles, FEGs, IFEGs, liquidity, order block, new day opening gap, and new week opening gap. So if you've been studying ICT, you've definitely learned at least half of these, at least the basic ones, FEGs, liquidity, order block. If you're new, we're building a little mastermind in our Discord, which is going to be released soon. We basically have all the, like starting from the basics into like more in-depth deep dives into FEGs, deep dives into breaker blocks, time-based concepts. So if you do want to see that once we release it, this is also part of that mastermind number 2. I'm just going to cover only like the surface, but anyways, continuing. So you've probably learned most of these, and that's great. If you actually know most of these, you're pretty much set. Like if you actually understand how to mark them out, how to find them in your charts, you're pretty much set. And the last thing that you need in order to actually build a model that you could consistently trade would be the time frame aspect. The idea of using multiple FVGs instead of multiple on the same time frame, you start looking at a higher time frame and scaling it down. So let's hop into the charts. I wrote both of these on the side right here so you can look at them if you join late. And I'm just going to go over the most recent example of a low probability like buy. So obviously starting off, what I actually marked out here was this weekly fair value gap, and I'm on the Forex version of NASDAQ. That is NDQ 100. So you can see that we've been trading around this weekly fair value gap, 1 week. That's the time frame, weekly fair value gap. This is a bearish fair value gap that we closed up above, creating a IFVG, right? So starting off, we have a confluence on the weekly, which is significant. We do want to mark it out. If we're trading around a weekly range, you want to mark it out. If you're trading around a monthly range, you want to mark it out. Since nothing existed on the monthly range nearby, I don't really have to worry about it. I start scaling down. So the first thing that I want you to write down, or at least memorize when it comes to building a model, is scaling down time frames. Okay, that's the first step of a profitable model. Scaling down time frames. And what you scale down with is the confluences that surround you on that time frame. So that's the first thing. I'm gonna hop on the futures chart in just a moment to show you guys on the futures as well how it aligned. So here we have a weekly IFVG, but starting off before we even ran to that weekly IFVG, since we're gonna be backtesting a little bit, I'm gonna mark this one out as well. This is a regular FVG. Okay, this is just a bullish fair value gap, and then right here, these two down close candles, that is an order block. For those of you who know, let me mark it out. So you take it from the top of the bottom candle, order block, but the entire order block is the range from all the candles that form the order block. Right, so this would be a high probability order block because as it started running back up, we created a bullish fair value gap. Okay, so I'm just marking out the highest time frame that we can work with, and then we're gonna scale down. So now that we go down to the daily chart, we're actually gonna scale a little bit past because I want you to dive in a little bit deeper into here. But we can like look at the liquidity here, right? It's a little more clear on the 4-hour chart. So first of all, we're looking at this. We'll come back to this actually. We're going to be looking at when we finally closed above this weekly fair value gap, right? This is the weekly bearish fair value gap, which once we closed above it here, it became a bullish inversion fair value gap. Okay, and now that with the idea that it's a bullish inversion fair value gap, you're trying to look for some buys in the following week. And finally, we get the retracement into the bullish fair value gap. Now what we're going to look at specifically is this right here. This is the first time we pulled back into it after it was an IFVG. Look at how it ran back from here. But the important thing that you want to consider and look at right here is this. This is a bearish fair value gap. And look at the first time that it actually pulled back. I want you to question yourself. Why did it actually pull down here instead of run up higher if we were expecting buy side from this IFVG? Why did it not go higher and take out these highs? Why did it run back down? And the reason for that is even though we swept this liquidity, we were missing something, right? There was only two or even one confluence right here on the 4-hour or higher time frame, which was simply a weekly fair value gap and some liquidity. So we did get the pullback, but it wasn't enough to hold, right? It wasn't a position that we can continue trading. We couldn't layer positions more. As soon as it tapped into this bearish fair value gap, we ran back down. Why? The answer to that question is because we didn't form neither a fair value gap nor an order block. And look at the significance of the second time that it actually ran down and swept this liquidity. So now we have a internal low right here when we swept this, right? We have a clear liquidity. It's closer. It's not so far away into the past. It's in the present week. And as soon as we swept this and started running up, do you guys know what formed right here? These two bearish candles. And once we ran up above these two bearish candles, that became an order block. not only did we get an order block, but we also got a fair value gap. Right? So now we're talking. Now we have a trade that can potentially continue going towards buy side. It's not just a little pullback and guessing that we can continue from here. We have a higher time frame, which is the 4-hour, order block, and a fair value gap. Right? So look at how we've been trading these last 2 weeks. Right here. All the bodies staying above the midpoint of this 4-hour fair value gap. Right? Tapping, wicks tapping into the order block, but overall pulling back up to the midpoint. So when it comes to, first of all, using the confluences, you want to make sure that you're first understanding the higher time frame. On the higher time frame, you need a long-term bias. This singular pullback right here isn't enough for you to start scaling down into the lower time frame and trying to look for a trade. Okay, the next thing is on the 4-hour time frame. I want you to pay attention to the fact that each candle is 4 hours. So that means that New York session itself is from 7, 8, 9, 10, 11, 12, and then we have PM session. So it's 5 hours, right? So how are you going to trade a session on the 4-hour time frame? You can't. And that's when you start scaling down. So people that trade the 4-hour, it's a little bit questionable. People say, oh, I don't need to go lower than the 4-hour. It's a little bit questionable because you're not getting the highest probability trades. The highest probability trades happen within a session, and each session has its own characteristics. So we're going to start scaling down. And we're going to specifically look at this range once we start pulling back into this 4-hour fair value gap. So the 4-hour fair value gap formed right here in this buy side leg right here, and then we started pulling back into it. We can kind of see the same thing happening right here. So see the first time that it pulled back into it, it's kind of the same thing that happened here. The first time that we pulled back into it, we got a pullback, just like right here. We got a pullback. But we didn't pull up high enough for this to become a order block. It's better for price to actually run back in here, first create some sort of order block, and then it could run. Right? That's what price likes doing. It likes tapping into the first time, then coming back, sweeping that liquidity. We tapped into the order block. So look, we're on the 1-hour time frame, and as soon as I go to the 30-minute time frame, you'll start to notice these sessions. So now we've scaled far enough from the higher time frame. Where is my sessions? There you go. Just took a little while for them to load. There you go. So now that you have an idea of what price is going to do, right? We finally pulled up from this weekly fair value gap after sweeping the low. We created a higher time frame order block on the 4-hour time frame. And now we're going to try to find a trade within a specific session. So obviously this is the NASDAQ. So are we looking for a trade on the NASDAQ, which is a USD based pair, during Asia range? The answer to that question is no. That would be a low probability trade because you're trying to trade a USD based pair in a JPY based session. For gold, you can, and I actually love trading gold during Asia session. Why? Because gold is backed by the JPY currency. It's a safe haven asset, and most euro is backed by gold, or yeah, that's right. Euro is backed by gold, JPY backed by gold, and USD backed by gold. So there's basically volatility in each of these sessions. But for a USD based pair like NASDAQ, which is based off the US dollar, it's not going to move much during Asia. And even if it does, it's not a high probability. You don't expect this or see it every time happening over and over again. So what would you do? You would wait for a session that you can actually trade, which would be New York. You can see that we're already leaving the 4-hour fair value gap after tapping into it. Right, we close inside of this. On the 4-hour, it was just wicks, remember, and all the bodies were closing at the midpoint right here. So we finally leave it. We created some order blocks right here. This became an order block range, and we finally left. And approaching New York session, we're looking at the nearest inefficiency. So what you'd mark out is the nearest inefficiency. We wouldn't no longer look at the stuff down here because it's irrelevant to us when we're trading up here. So if you begin to see what I'm actually looking at right here, on the 30-minute time frame, we have this 30-minute bearish fair value gap. And at the start of New York session, we started New York session and closed above it. So what does this bearish for rally gap become? It becomes a IFEG. And this is now a bullish confluence. So while it does look like it was consolidating like crazy, remember Friday didn't have any news, it was still respecting the price action that existed there, which was the inversion for value gap, right? I don't actually want to look at this example, so we're going to dive a little bit further into the past, because this isn't really the highest probability example of what happened. Like, this would have been a good chance for you to maybe take a swing trade to avoid kind of the consolidation, but even then it's not the best trade right here because of the consolidation, low probability day. But you can see how I was kind of scaling down on the time frames. So let's go a little bit further into the past. We're actually going to look at this right here, which is perfect because this is a New York session, right? And as soon as we start trading this New York session, this is a Wednesday, October 16. Let's go on Forex Factory. So to go back to this Mastermind 2 slideshow, remember I started with what does a model consist of? That's time and day of week. So the first thing you want to look at is news. So this was the 16th of October, right here, no news. However, this isn't a bad week, to be honest. It already passed Monday and Tuesday, which was a bank holiday, so there was likely a lot more consolidation during these 2 days. However, now we're a Wednesday. This isn't an NFP week, nor is it a CPI week, nor is it an FOMC week. So the days before this, these unemployment claims aren't really going to be like chopping up too much. If it was a higher impact news driver, like one of these, then the day before is low probability because these news events want to sweep some sort of highs or lows that are built up. Right, so in this case, while it might not be the most optimal day because we don't have news, what we wanted to see, our setup is beginning to form, right? We finally started running down during this New York session and we swept the low into this weekly fair value gap. So now that we swept this low, we begin to dive even lower into our session, right? We're on the 30-minute time frame. We're going to dive a little bit lower and start looking for that trade. So we are expecting, now that we got these 4-hour candle closes right here, 9:30. Let's go to the 4-hour time frame. So when I would start looking for that trade is once this 4-hour candle closes, which is 6 a.m., right? So at 7 a.m., once 6 a.m. candle closes and the 10 a.m. 4-hour candle, but technically on the lower time frame it's just 7 a.m. So this closes at 6 a.m. and the new daily candle opens. Not daily, 4-hour candle. So that's right when the New York session starts. Sorry, I got a little bit confused. So we're going to dive even lower. Now we're going to go to the 15-minute time frame. Remember that the 4-hour candle closed right here at 6 a.m. or from 6 a.m. until 4 hours, 10 a.m. So it closes at 10 a.m., right? So this is when the 4-hour candle closes and the new 4-hour candle opens right here. Okay, you can see what already happened. As soon as this candle closed below this, and now we have two bearish 4-hour candles right here in this range. So we can begin to anticipate that now price is going to try to pull back up because we just swept some liquidity. We got two bearish candles, which now allow us to form a 4-hour order block. And you can see right here, as soon as we ran up, you wouldn't trade from liquidity. It's just not enough confluences yet. But we got our first fair value gap right here. And you can see that we didn't close below the low right here. The candle stayed within this range. And then we started pulling back up again. Pulled back up. Still no order block yet. But then we got two candles right here. And then we pulled up again. And while this is in the afternoon, nothing invalidates the trade if your setup only begins to show itself in the afternoon, which would be PM session. A lot of our VIP students know that I trade PM session even more than I trade the morning sometimes. Why? Because of the daily candle closing. Like the daily candle has a target, and that target like is obvious in the afternoon when it's a few hours before the daily candle closes. It's already like manipulated, it already ran up, and it's just like a few more pips away from its target, and I simply would just execute from the high to finish off the daily candle movement. So it's a little easier trading in the afternoon for me. And here we finally got an order block after leaving this fair value gap right here on the 15-minute time frame. And at around 1:15 p.m., remember the PM silver bullets at around 2 p.m. right here. So we finally got our order block, right? We get in our trade right here, and we target maybe the close above this fair value gap, which would make it an IFVG. That would be an example of kind of considering everything that's going around in your like time frames, right? First, we leave the weekly time frame. We swept some liquidity. We got our first fair value gap on the lower time frame. Then we got our first order block on the lower time frame, and we finally tab back into the order block. The candles close above it. So your confirmation isn't that we got an order block. It's like once the candle, like the order block forms, and then the candles start returning back into it. Your confirmation is once you see this first candle, like run into it and run away from it. It like shows you that the order block is holding price back. It taps into it, but it wants to go higher. Just like ICT says, wicks do the damage and bodies tell the story. And the story that the bodies are telling us here is that even though we tapped into this bear or bullish order block, these two bearish candles, price pulls back up, right? A new candle opens, and that's when you get in. We instantly get that run up to buy side right here. We barely swept this liquidity, and then 2 a.m. hit, so the silver bullet started pulling back down. But you would have gotten out of your trade because New York session closes already, right? And all you really need is some liquidity. We swept this liquidity, started pulling back. And if you ended up holding your trade from here, your confirmation would have been to get out of the trade. Your confirmation would have been, so look, you're holding this trade, you want some more profit, and price starts pulling back in. You just kind of mark out the confluences nearby, and once you finally see, okay, look, we closed down below this fair value gap, this is likely going to be an IFVG. Look at how this candle respected it. Taps back into this IFVG, and we go lower. So you could have gotten out of your trade right here. You would have still been in profit if you got out like once it closed below. That's why you have to have a system of like partials as well. And that would be more on like a video about risk management and psychology, because everyone's psychology is different. And when we're talking about psychology, what you need to consider is contentment. Being content with how much you being content with how much you would make in a singular trade. So contentment. That's what like your psychology is about. Like being happy with 1K or 2K in that like live account. If you're able to be content with this, that's when you get out of your trade, right? You're not just targeting the highs. If you're at up like 2K, look, let's see you get into the trade at this order block right here. And as price is running up, you're right here inside of price, right? This is where the trade is at right now. And you're already up 2K. Like even though it could continue going higher and hit your target, 2K is a lot of money. And if you're content with that, you get out of your trade and you have a profitable, happy trade right here. Right? And that's what like makes me a good trader. Like that's why I'm able to pass accounts, is because most of the time, like while I can just hold to my target, you don't always have the guarantee that your target is going to get hit. And that's why you want to scale in and learn to get into like these high probability positions where you can get in with more risk, have a tighter stop loss, and then get out of the trades earlier. Okay, so back to topic, right? How do you combine these? As I've been showing you, time frames is the most significant thing because you want to have a story. You want to have a idea of where the market is going on a long, like higher time frame. And that story comes from like using the higher time frame fair value gaps. I'd say out of all the concepts that exist in the entire market, fair value gaps are the most important ones. Like, that is probably the singular best concept that exists out there in the market, because first of all, it exists in the market. Like, it's not something that you add to the charts. Like, it's not support resistance type of stuff. It's not like a support zone or whatever they call it. It exists in the market, and it's an actual gap. And on the higher time frame, you can literally see, like, the best example of this, of fair value gaps being put to work, is on gold. So I'm about to pull up the gold futures weekly time frame. This is the best example of why fair value gaps are literally the best concept in the market. So we're looking at a weekly time frame, as I've been telling you guys. Look right here. Weekly fair value gap forms. Price finally returns into this weekly fair value gap and runs higher. The next weekly fair value gap that forms, price finally returns to the weekly fair value gap, taps in, and goes higher. And what happens like a few weeks ago? The next weekly fair value gap forms. Price finally pulls back into this weekly fair value gap, and what happens? We run to all-time highs again. Why do you think that fair value gaps wouldn't work like this on the lower time frame? It's the same exact thing. All you do now is go inside of a singular daily or weekly range like this. You're bullish, right? Because gold has been going up for the last year, like months and months and months of bullish price action. Why would you be bearish on a chart like that? Another thing right here, weekly fair value gap. Taps in, goes higher. Taps in again, sweeps the low, stays within the midpoint, runs higher. Forms a new one. Taps in, goes higher. Fair value gaps are the best concept in the market, and you should be using it. Same thing on the daily time frame. We have bullish fair value gaps, and they're used the same way. Look, in between the weekly fair value gaps, look, same thing on the daily chart. Fair value gap forms, price finally pulls back into it, goes higher. And that's what tells you the story. Now what you do is you use the fair value gaps as your bias, right? Then you hop into the daily candle. This one closes, new day opens. You would hop into the, let me go into replay mode. You would hop into a daily candle, right? Now we're inside of a daily candle after the previous candle just closed bearish. Look, we just closed bearish. Boom. We tapped into a fair value gap. We pulled back, and the new daily candle is about to open. This is my model right here. I'm about to show you guys my model. So we're going to go on a lower time frame, 4 hour. So the idea of this model is power of 3, which is the movement of the daily candle. We tapped in, right? We closed. I'm going to go to the 30-minute time frame because I already have the narrative, right? We closed into a bullish daily fair value gap. Oh, I might not be able to go lower because it's so far in the past. Or my chart's just bugging out. Yeah, I'm just glitching out. Give me a second. I guess in the meantime, I'll look at some comments. Okay, somebody asked, what type of model do you see in gold Asia range? So remember, this is the gold pair. It's simply a futures, but it's the same thing. It's the same price, everything. Look, we're now inside of the Asia range. Like I was telling you guys, right? Previous candle closed right here. Right here, New York session. The New York session ends. We close right there at 4:45 Wednesday. Then the new day opens, right? There you go, 8 p.m. Asia session starts of a new day. Let me pull up power of 3. Look at this. This is how the new day candle looks right now. So I can go back a little bit further. Let's go right here just to show you guys. So look, this is how the daily candle currently looks, because the previous day candle closed bearish and the new daily candle opened, and it doesn't have a candle yet, right? This is all it looks like right now. And what you do is, after the daily candle closes and a new day opens, you wait for Asia session to happen. Boom. Skip to Asia session, right? You're just chilling there waiting for your alarm to go off telling you that it's Asia session. There you go. Asia session happened. And what I typically look for now inside of Asia session is an inversion for value gap. So this might be the one already right here. We finally closed above a bearish for value gap, but it's also likely that if the daily candle comes below, since it already has a wick, it doesn't have to. So we'll just see what happens right here. Okay, do we sweep the low right here? There you go. We swept the low. And what happens right here is that the daily candle just created a wick. Not only did we just sweep some equal lows right here, right? We swept some liquidity, but we also just created a big wick on the daily candle. And this is the first step of Asia range. This means that the daily candle moved in the opposite direction of where you wanted it to go, because we're inside of the daily bullish fair value gap. So we want to go up. Right? And what just happened is that the market ran down against where you wanted it to go. Obviously, it wanted to go up, and it ran down. So this is perfect. This is the highest probability time for you to get into your trade. So what just happened? We finally created our first fair value gap, which happened in the move against our bias. So this is a 30-minute FVG. And my model is like this, guys. Simple. In the move in the opposite direction, it creates some sort of inefficiency, and all I do is I wait for it to close above that inefficiency and tap back into it. So look, now that we got this fair value gap, all I have to do is wait for it to come back up and close above it. Boom, we closed above it. It might not return just because this is a weekly fair value gap. So if I get another fair value gap in this leg, I would simply trade it from that one. Then we also created an order block right here. Like I said, the first time it runs down, that's good and all. But the second time, it creates an order block. And that's what happened right here too. You can see it swept the previous low and created a bearish candle, which is a bullish order block now. Now we have a high probability set of confluences that all align. Liquidity right here. Order block right here. New order block after taking out the high right here. Right? We have a new order block right here. And once the next 30-minute candle opens and closes, we're going to get a new fair value gap. Boom, new fair value gap, 30-minute fair value gap. So now, sure, it could go back to the IFVG right here. This now became an IFVG. But it could also just run down from this one. So we're waiting for a pullback, and that's my trade. That's it. That's how I would trade. I'd wait for it to close above, and I'd trade from that range. So obviously this is a daily candle, and we're extremely bullish. So if it doesn't give us the trade, that's fine. Okay, we just pulled back from a fair value gap right here. If we stay within this one, so you can see the body stayed within this one, we can just continue the trade because we barely missed this right here. This is still high probability. We're still inside of the Asia range. And we close, we're showing some buy side. And if you don't want to miss the move, you simply target this right here from where you're currently at. If it takes you out, you can be a little more patient and hold until a higher probability confluence. But this is enough, right? Sometimes during London session, you'd get the pullback. Okay, let's look for it to pull back into. Okay, perfect. We finally tapped into this. Look at this right here. So if you were impatient, you wait for the perfect moment. Look, this is called an institutional order flow entry, where we tap in. This is also now below midnight price, right? Midnight open price right here, 12 a.m. We traded below it in the next candle, tapped in right here, and this is our high probability entry. And now we target the fill of this fair value gap. Secure under the low. Boom. That right there is a profitable system. because in this model right here, we got, first of all, the story, which was from the daily time frame. And the story is that we ran down into the daily fair value gap and closed, and the new daily candle opened. And inside of the new daily candle, we waited for Asia range. And inside of Asia range, we traded against the bias, creating some inefficiencies. And look at this right here. This is the fair value gap inside of the bullish daily fair value gap. So the 30-minute and the daily candle aligned perfectly right here. And when we tapped into it, that's when we started running up. And then we simply aimed for a high probability target right here. Okay, that's going to be all for this stream. I'll answer any questions if you guys have any questions. Shoot them now. Alright guys, see you guys next time.